As of today, Sunday, December 21st, 2025, the stock market is closed for the weekend, but it is impossible to ignore the massive wave of activity surrounding Warner Bros. Discovery, Inc. The latest closing price for WBD on the NASDAQ stands at 27.77 USD, which represents an intraday increase of 0.16 USD or 0.58% during the final trading session of the week. While a 0.5% move might seem quiet in the context of the broader market, the after-hours session saw the stock climb even further to 27.99 USD. This tells a story of extreme tension. Most investors looking at their Fidelity mobile app or checking their positions on the Robinhood app right now see a stock that has rallied over 160% this year, but the immediate reality is far more complex than a simple winning streak. The stock is currently caught in a high-stakes struggle between two distinct outcomes, and what most people do not anticipate is that the current price action is no longer reflecting the value of movies or streaming subscribers. Instead, WBD has effectively become a merger arbitrage instrument. The gap between the current price and the competing bids is the only thing the institutional desks at Interactive Brokers and Fidelity Investments care about right now. The common belief among retail investors using various investing sites is that the stock is capped at the 30 USD mark because of the hostile all-cash tender offer from Skydance. However, the deeper reality you need to consider is that the WBD board is digging in its heels. Just days ago, the board officially recommended that stockholders reject that 30 USD cash bid and instead approve the merger agreement with Netflix. This created a massive curiosity loop for the market because on paper the Netflix deal is valued at approximately 27.75 USD per share. If you are doing your own online investing or managing a self-investing account, you might ask why a board would ever tell you to take 27.75 USD instead of 30. The answer lies in the structural certainty and the long-term vision of what remains after the deal. The Netflix offer isn't just about cash. It includes a mix of cash and Netflix stock with a specific collar mechanism to protect you from volatility. Meanwhile, the board has labeled the Skydance bid as illusory, citing concerns over financing and the lack of a hard backstop. This creates a fascinating psychological floor and ceiling for the stock that is keeping the volume at historic levels. When you look at the recent trading volumes, which exceeded 130 million shares on Friday, you can see that institutional activity is hitting a fever pitch. We are seeing major players like Harris Associates, one of the top 5 shareholders, signaling that they are open to the higher cash bid if the terms are improved. This is the kind of detail that doesn't always make it into the basic summaries on a Fidelity trading platform or a SoFi active investing dashboard. It shows that while the board is pushing one direction, the actual owners of the company are still looking for the highest bidder to blink. This tug of war is why WBD is behaving so differently from something like Tesla stock or Nvidia stock, which move based on technology cycles and retail sentiment. WBD is moving based on legal filings and creditworthiness assessments. If you are using Schwab Intelligent Portfolios or other automated tools, you might notice that your exposure to the media sector is becoming increasingly concentrated in this one name because of the sheer weight of the transaction. If you have been watching the daily swings, you know that WBD has spent the last month testing its 52-week high of 30 USD but failing to break through. Every time a headline suggests the board will block the cash offer, the stock drifts back toward the 27 USD range, which acts as the anchor for the Netflix deal. This creates a unique opportunity for those involved in online investment strategies who understand the difference between a deal that is signed and a deal that is merely proposed. The institutional desks at Interactive Brokers are likely looking at the $2.8 billion termination fee that WBD would owe Netflix if they walked away. That is a massive weight that the market is currently pricing in. It means Skydance doesn't just have to beat the Netflix price, they have to beat it by enough to cover that penalty and still look attractive to a weary shareholder base. Comment below how many shares of Warner Brothers Discovery you currently hold, and whether you would prefer 30 USD in cash right now or the Netflix partnership for the long run. Taking a step back to look at what this company actually does, we have to remember the history of how we got here. The 2022 merger between Discovery and AT&T's Warner Media was supposed to create a content titan that could rival Disney. For a long time, the reality fell short of expectations. The company was saddled with over $40 billion in debt and a declining linear television business. However, under the leadership of David Zaslav, the focus shifted towards aggressive debt paydown and streaming profitability. By the third quarter of 2025, the company reported that its streaming segment had finally delivered over $1.3 billion in EBITDA, a massive swing from the multi-billion dollar losses of previous years. This is why the stock was able to climb from its 52-week low of 7.52 USD. The business model became leaner, focusing on massive franchises like DC, Harry Potter, and the HBO library, while treating the legacy cable networks as a cash source to fuel the transition. For those using Robinhood stock trading or SoFi stocks to build a portfolio, the narrative has shifted from "can they survive the debt" to "who gets to own these assets?" The proposed plan to spin off the legacy networks into a new entity called Discovery Global by 2026 adds another layer of value that isn't immediately obvious. It allows the core studios and streaming assets to be absorbed into a larger platform like Netflix without the baggage of declining cable ad revenue. This is a classic example of creating value through separation. When you look at the Fidelity Wealth Management reports or listen to analysts on interactive brokers trading platforms, the consensus is that the sum of the parts is finally being recognized as greater than the whole. However, the risk remains that if both deals were to fall through due to regulatory scrutiny, the stock could see a significant correction back towards its fundamental valuation, which many see as being in the low 20s. The macroeconomic pressure of late 2025 also plays a role. With interest rates finally stabilizing, the cost of financing these multi-billion-dollar deals has become more predictable, which is why we are seeing this surge in merger activity. Investors who use investing sites to track sector momentum will notice that while Apple stock and other big tech names are dealing with their own antitrust hurdles, the media sector is in a full-blown consolidation phase. This is where professional guidance or a SoFi robo-advisor might suggest caution, because merger arbitrage can be incredibly volatile for an individual brokerage account. The gap between expectation and reality here is the regulatory environment. The expectation is that the Netflix deal will face fewer hurdles because it involves a strategic asset split, but the reality of a global streaming leader getting even larger is something that the Department of Justice will surely examine. When you consider your own investment help needs, think about the tools you use. Are you checking the Robinhood app for quick updates, or are you utilizing the deep research available through Fidelity IRAs and Fidelity mutual funds? The way you digest this information matters, because the news cycle for WBD is currently moving faster than the actual stock price. The heavy institutional activity suggests that the smart capital is betting on a resolution before the end of the first quarter of 2026. This is why the intraday low of 27.58 USD was so quickly bought up during the last session. There is a clear appetite for shares whenever they dip toward the Netflix deal floor. It shows that the market has a high degree of confidence that the company will not be left at the altar. Looking toward the future, the outlook for WBD depends on which path is taken. If the Netflix merger proceeds, you are looking at a transformed company where you hold shares in a global streaming powerhouse and a separate high-yield dividend-paying entity in Discovery Global. If the Skydance cash offer wins out, you get a clean exit at 30 USD, but you lose the potential upside of the 2026 content slate, which includes some of the most anticipated DC projects in years. This is the ultimate choice for those who engage in self-investing. Do you take the bird in the hand, or do you wait for the larger flock? The catalysts to watch include the next earnings report in February and any formal filings regarding the Skydance tender offers financing. Any sign of weakness in the rival bid will likely cause a short-term drop in the stock, while any improvement in terms could send it straight to 30 USD. The contrast between the market's initial skepticism and the current bidding war is a testament to the quality of the underlying assets. People often forget that WBD owns some of the most iconic intellectual property in history. While many retail traders are distracted by the volatility of Robinhood crypto or the latest swings in Tesla stock, the serious capital is focused on the long-term cash flow potential of the HBO library and the Warner Brothers movie studio. This is why Fidelity Investments and Interactive Brokers account holders have seen such a massive influx of interest in this specific ticker. It represents a rare case where a legacy business successfully pivoted and became the belle of the ball in a consolidated market.